Buy a business guide. Buy a business introduction. This is about how to buy an existing, established business. Take over a sick business. Leveraged buyout, buying a business using a loan with the business as collateral. Mergers and acquisitions. Commercial real estate. Buying a franchise or franchising your business. I cover how to buy an existing individual business by checking it out first by doing your due diligence, which is not that hard. Simply drive past the place a number of times to see if there are many customers. Pop in several times unannounced to see what's going on. A business opportunity or BizOp is a business plan, method, turnkey operation, or idea you buy from someone for a set fee, then there are no fees after that, unlike a franchise where there is some deal to either buy a product from the franchisor or pay a certain commission on profits for a certain amount of time. Mergers and acquisitions are for someone who owns a company. They either merge with another one or are acquired by it. Commercial real estate is a broad term covering business real estate. Quite often, this ad category covers existing businesses for sale. Most businesses for sale advertise in the following places: local newspapers and online ads like on Kijiji and Craigslist. Through local, regional, and national commercial real estate agents. General business brokers that look for buyers of businesses listed with them or listed in a database like the MLS for businesses. Specific business brokers for a field. Trade mags, websites, and journals in a field with ads. Franchises might help by giving name recognition, but the way I see it is that you're spending a lot of money on nothing, or maybe it's fear and you think that by buying a franchise, there is some security and guarantee of success, but there isn't. You can study the franchise business yourself, then set up your own business that's similar to it. It will be cheaper and you'll have the freedom to do what you want. You can't just copy their design and make your place too similar though. That would be called trade dress. They'd probably sue you in civil court. You're creative enough to create your own name, logo, business decor, etc. The best advice I can give is look before you leap. When you watch those business pitch shows on TV like Dragon's Den and Shark Tank, at least half of the deals made on TV fall through because the investors do their due diligence, see something they don't like and back off. Every business owner or franchisor trying to sell their business whitewashes their business. You have to see it all, including the gritty down times like what's going on a sleepy Friday afternoon. If you're trying to sell a business, be ready for heartbreak. Prospective business buyers are usually shrewd investors. They come in and put the business down, name several defects they saw, then give a low estimate to try to get it as cheaply as possible. It's the way they do business. There are often several people who come in acting interested, then they back out. Don't leave it to a broker. Find trade magazines in your field. Advertise in them and websites dedicated to your field. For more information, the SBA/SBA.gov has a booklet called Buying and Selling a Small Business. Books about buying and selling a business at number 658.16 or HD 1394 at the library. International Business Brokers Association. IBBA.org. Chapter 1. Buying a Business 1. Buying a Business Guide. Within the business of buying and selling businesses, some industry players in a particular business/industry create equations of what the business should be sold for, like 6 times the annual profit or something like that, but the truth is that every business is unique. Formulas don't really apply. If you're looking to buy a business, do your due diligence research and use your intuitive insight to get a feel for it. These are the best of times and the worst of times. The same holds true today in the buying and selling of a business as was the case in Dickens' times when he started his novel A Tale of Two Cities with the above statement. It's the same with any generic piece of real estate. Even though the general economy will somewhat determine the market overall, with lower prices in a bust economy and higher prices in a boom economy, most businesses are treated as individual entities regardless of the conditions in the economy. If the business is good, it will sell at a reasonable price. If it's not so good, it will either sell for a low price or not sell at all, in which case the owner will either have to keep it or liquidate it the best way he can. If you want to sell your business, Keep it in good condition so that it looks good when potential buyers come around. Make up a prospectus, a report about the business, come to a determination of its value, advertise it for sale as such and see what happens. If you want to buy a business, don't buy during the boom period, usually summertime and Christmas. Wait until business is really slow to approach the owner. Look in the yellow pages under business brokers to find someone to either help you buy or sell for a fee. They're often worth the fee because they know what's going on in this obscure field. After you decide to sell your business, you have to put it in working order paper-wise and physical-wise, looks, in order that it be straight up all there in an uncomplicated way when prospective buyers come calling. After this, advertise, use a business broker or some other means to bring potential buyers in. If someone is interested, this starts a due diligence phase where you have to disclose the details of the business to this person and he or she shows you that they are creditworthy enough to buy it. There is a negotiation stage, the sale, then the post-sale stage where the seller usually stays on for a while to help the new owners transition into it. It's a complex legal process. Regardless of whether you're buying or selling, do your homework, investigate the potential buyer or seller to see what they're all about. From a legal standpoint, unincorporated businesses sell assets which are on a list of what is being sold. Incorporated businesses can sell either assets or shares. Mergers are transactions where one business takes over another. An asset purchase is to pick what you want from among a company's holdings/assets and buy them one by one, piece by piece. For example, if you walk through a company, you make a list of what you want and then make a deal for them if the owner agrees to sell this way. Some things the buyer might not want, like the building, old equipment, old inventory, etc. If this is the only way for the owner to sell rather than to liquidate in a flea market type sale, so be it. Often a competitor will be open to buy some of the equipment of a dying company and maybe even the building for another retail outlet or branch plant. With an asset sale deal, the seller is stuck paying taxes on the cash he earns. There is also no legal exchange of the company per se. The buyer has made no claim on the selling company. The selling company is still a solvent, legal entity even though it has just sold its primary means for earning a living. Asset purchase plans are generally the way all non-corporate companies are sold, such as with a sole proprietorship or partnership. The asset being purchased might be the entire company for a single flat fee, or it could be a piecemeal thing with the buyer going through, making a list, then negotiating with the seller on the price. A business sale is generally not like a home sale. There are usually some conditions there where the seller has to help out with the transition. The bottom line is always money. The business has to look profitable in order to sell, and the buyer has to have ready cash if he wants to make a deal for a reasonable price. As a new business owner, keep the old employees and suppliers at least for a while until you know what's going on. Stick with the facts. Read all the documents and understand them before you sign. There is a lot of government red tape. Hire a business lawyer to help you through the process. If you're selling, approach larger companies in your field and ask if they want to swallow you up. Who gets control of patents, copyrights and trademarks? Are they worth much in terms of sales? There are business appraisers who can do an appraisal of a business for either buyers or sellers. Use trade publications in your field to find buyers and sellers. Despite all the analyses I've read about in books about buying and selling businesses, the bottom line is to trust your own intuition in the end. Buying a Business 1. This chapter is a brief summary of the booklet Buying and Selling a Small Business, published by the Small Business Administration along with information from other sources. For more information, contact the SBA/sba.gov to get a copy. Books about buying and selling a business at number 658.16 or HD 1394 at the library. Buying an existing business could be easier than starting one from scratch because it's presumably already set up in such things as the site location, inventory, suppliers, and an established customer base. Buying a business doesn't mean continued success because businesses in general, especially small businesses, are often successful because the owner is a decent guy or gal who is nice to his customers and gives them what they want. If you buy an existing successful business and go in acting like an asshole, the customers will leave. The bottom line to finding and buying a business is to keep it simple. Once you've found your business, talk straight to the seller, come to a basic agreement as to what it contains and how much he wants for it, then do your own market, financial and legal research. Don't get bogged down with trivial matters. Get a gut feeling for the profitability of the business and go with it. Hire a professional to look the books over if you have to. In some ways, the person who buys a going business has an advantage over the one who starts from scratch. For one thing, there are more facts to work with if the buyer knows where to find them and how to use them, plus the fact that there may be good bargains out there if there's a good reason why the owner is selling, like he's old and just wants to get out. You will have an established business with a customer base, so you will forego all the risks of starting a business. When valuation of the business has been completed, the players get together to negotiate price, down payment, and terms. In some cases, the owner wants 100% of the price, which often means the buyer has to get a business loan from a bank and carry a mortgage. In other cases, the buyer will agree to something like a 20% down payment with monthly payments for X number of years. There are all kinds of variations of money down versus payments later out of future profits. It depends on how far the seller is willing to bend versus how much money he wants up front. Negotiating the purchase of a business and the terms of the sale are highly subjective affairs based on the people conducting the transaction. The art of negotiation is compromise. If you're too hard-assed, either side might pull out and you will be left with nothing but a wasted effort. Give a little bit. Find businesses for sale in some publications like the Wall Street Journal, Inc. magazine, and local business and general newspapers in your area. Talk to people. Check with your local chamber of commerce, business, and trade associations for leads. Just as there are real estate brokers for houses, there are business brokers for businesses. Find one in your area by calling up several real estate companies, then ask him to show you a few businesses. Try looking up business brokers in your phone book. Check out several brokers to see what they have to offer. Have your financial information all ready for him to see, because he won't show you around unless he knows you're for real. Don't underestimate a good business broker. He gets his commission from the seller. Buying a business is complicated stuff. Take advice anywhere you can get it. Find out why the owner is selling the business. Go visit it physically, take a good look around and talk to the employees in private if you can. Drive around the area to see where the competition is. Look in the phone book to check on the competition too. Possibly ask to inspect the books. Write an offer out on paper about 10 to 20% less than what he wants for it and submit it to him. Write out what kind of financing you have or explain your financial proposal to him. If they don't go for it, tell him you will call him in a month or so to see if he changed his mind. Negotiate either the lease or the selling terms. If the business is on leased property like in a shopping mall, you have to make a deal with the landlord. Execute a lien search on the property, possibly through a lawyer or by simply going to the county courthouse yourself and asking for the records. Do an inventory on everything in the place that you get with the deal, then close the deal. Factors to consider before buying a business. Does it make money? What are the earnings? Value on paper. Startup cost. Hidden liabilities like retirement plan. Common sense. Industry standard for that the type of business. You have to know basic accounting to read the company's financial statement. If it's a public company, read its quarterly and annual reports. When checking out a business, verify what they tell you they have in terms of goods, services, and tools/equipment. Ask to see copies of whatever patents and/or copyrights they might have. Get your lawyer to check them out for debt, taxes, legal litigation, liens, and any claims against them that you might be responsible for. Check out how well they sell, who their market is, who's their competition, how widespread, the possibilities for expansion, etc. If you buy a business, make sure you have more money on hand than the cost of the business, because you will have lots of expenses getting it going. Trust your intuition. Don't necessarily trust the seller. He will most certainly try to hype it up. He wants out and won't necessarily be honest with you. Go in at off times to check out the customer base. If you own a business, the best way to get rid of competition is to buy it and make it one of your chain stores. When you buy a business, you usually need some kind of creative financing, like pay out some of the money out of your own pocket, get a loan from a bank for some, and ask the business to loan you some, or, in effect, make it like a balloon mortgage, pay them low monthly payments for now that will increase as your business prospers. This creative financing could get complicated. Try to work out some kind of equitable deal with the seller. Thoroughly analyze the business. Don't take what the seller says at face value. Determine its true value on your own. Pick out serious problems and pitfalls. Look for the true potential of the business. Investigation procedures are different depending on whether the business is a manufacturing, retail, or service operation. Take into account the age and reputation of the company, reason for the sale, money you require upfront, and your familiarity with the business. Unless you have solid experience in the type business you are about to buy, get outside help. Don't evaluate a business you know little about without getting an insider to help you. Negotiate by pinpointing problems the seller may have with the business. Before you buy, go over the purchase agreement with a fine-tooth comb. Plan the future business by highlighting areas of operational weakness and strength. In order to protect yourself, fork over the least amount of money as possible for a deposit and down payment. If you walk away, you automatically lose it. It's just the protocol of doing business. You're wasting the seller's time by tying up his business. In fact, specify that to the seller in a clause that he may keep the deposit as liquidated damages should you default. This could protect you from even further litigation by the seller. If you buy a business through your corporation, not you as the buyer, the liability will go to the corporation, not you personally, should you decide to default and not go through with the deal. This is one advantage of incorporating. In any case, get your attorney to read through the contract before you sign. Try to put a clause in so you can walk away within 30 to 90 days after purchase without losing anything but the deposit and the first few monthly payments. Simply tell the seller you want to check out day-to-day operations for a month or two to see how it goes. It sounds like a reasonable request, so sell him or her on it. In many cases, banks know of businesses up for sale. Buying a business too. Look for a business that has some connection to something you like to do. Be wary of buying a business you know nothing about. Look for a business you can grow easily and possibly sell for a profit at a later date. Find businesses to buy in. The most desperate people advertise in newspapers. Places like Kijiji and Craigslist have ads of businesses for sale. Word of mouth, people know who's trying to sell their business to retire or whatever. Business brokers help business owners find buyers. Trade associations, trade websites, and trade magazines have ads of businesses in that field for sale. Due diligence is your research on that business's financial records, including balance sheets, accounts payable and receivable, cash flow statements, employee contracts, and any other relevant information. Look for potential problems. See if there are legal problems. How long is the commercial lease for? Are there copyrights and registered trademarks? Find a valuer who can fairly appraise its market value. Most small-timers buy a company to go into business for themselves. Big-timers buy companies to grow through acquisitions, to add companies over and above what they already own. Whatever you do, get somebody independent of you or your company to check it out and give you an honest assessment. This could be a hired consultant or just a friend in the business who knows about the field. Get a specific suggested purchase price from them. The first question is your financing. Do you have the money to put up as a down payment, and can you handle the monthly payments? What is your budget? How much are you willing to pay for a new company? Can you get a mortgage loan? Has the business been proven in practice to be successful? Is it original? Is it in a growth market, or is it in a market area that's in a decline? Is there a strong brand name associated with it? What is its reputation? Will it make enough money so you won't run out of cash flow in the first year? What is the current market like in this field? Can you make a profit without trying too hard? Is the demand there? What about competition? Is there room for you and your competition? How cutthroat are they to put their competition, you, out of business? Does this business fit you as an individual or the company you're with now? Do you feel comfortable in this field or a fish out of the water? Is it in your area of expertise? Is it in or near your geographic area? Is the business located in a place where it can sell a lot of product, near a large population center? Where can you expand to? Are there any big companies or new countries you can sell to? What about sales methods? Are there other ways to package and sell these products or services? What are some unforeseen opportunities or problems that could happen with this business? What about unexpected costs? Regardless of its current operations, can you make a profit with this company and make it better? Is there a synergy between your current company/business and the company you plan to buy? Are they related in such a way that together, you can become bigger and better than the two of you individually? What about current debts of the company? What about new projects being implemented which have not yet turned a profit? Do you keep the current employees? Do you change the pay and benefits structure? If the managers had a very high salary, do you change it? Do you offer health insurance? Do you offer workers' compensation insurance? Current employees get angry if a new owner comes in and lowers their pay and/or benefits. They will sabotage you with lower performance. If you plan to do this, you should clean house and invite them to reapply under the new structure. Calculate all the expenses of running this business as best as you can. What about income taxes for the company in the current year? Who pays, the buyer or seller? The balance sheet carries all the assets and liabilities of the company. It depends on you. You could go with your intuition and make a straight man-to-man deal with the business owner, or the bigger it is, the more complex and analytical the contract will be. I've seen very complicated contracts in buying a business workbooks. You need a lawyer and a consultant to write them out because there's no way a non-expert could ever get all the points. They even cover depreciation. There is usually a non-competition agreement where the seller agrees not to open a competing business for a few years. Past performance is the best indicator of future success, even though the actual future results of any company is subject to unforeseen events. All projected earnings are optimistic fiction. Analyze the business risks of buying the company. One man in charge of operations in a business could be very deceptive. He could be lying through his teeth and you have no real way of verifying what he says. EBITDA means earnings before interest, taxes, depreciation, and amortization. By merging two companies, you can eliminate duplicate administrative and operation costs and keep the best people from both companies. Cover these points when considering buying a business. History of company. Business, what it does. Administrative organization. What does it own? Intangible assets and intellectual property. What is the seller's asking price? How did he come to that number? What about the seller's terms for the structure of the transaction, how you will pay, down payment and monthly, whether management will stay on, for how long, etc. What will happen to the employees? Will they stay or be fired and replaced by people of your choice? Will you get resumes from the managers, salespeople, and the key technical people to give you an idea of what they do and whether you should keep them? Will you get a list of the annual salary, bonus, and any other benefits every individual on the above list receives? Get a list of all the company payment and benefits plans and programs for every different class of employee. This includes management bonus, profit sharing plans, salesmen's commissions, bonus plans, profit sharing plans, retirement programs, and medical and life insurance. Which employees, if any, have signed non-compete agreements before the sale of the company that will still be valid after the sale? Total employee roster, including method of payment, salary, hourly, and pay scale. Organizational chart of management structure. List of non-employees receiving money from the company such as independent contractors, consultants, inventor of a product receiving a royalty, etc. Get copies of the annual balance sheets and income statements for the past 3 years as well as the most current statement this year. Get a list of accounts receivable and accounts payable schedules. Get a list of current orders and the backlog, if applicable. Get a number for total dollar and unit sales for the past few years, either totally or broken down by geographical region or retail outlet. If the nature of the business depends on a few major customers, get a list of these customers. Also get the company mailing list. Make sure you ask for this because if you don't, one of the enterprising employees will take it and use it for himself to start a new business. Get a list of the different ways the products are sold, like retail, through a broker, over the internet, direct mail marketing, catalog sales, through other retailers, etc. Get a list of the suppliers who supply the company with raw products. If applicable, get an analysis of volume sales of each product, its markup and gross profit. Many companies don't do this type of in-depth analysis. List of all business costs like labor, material, factory overhead, transportation, taxes, etc. Depreciation policies. What is their policy to write bad debts and obsolete products off? Does the company do a regular physical inventory of goods? Insurance policies and insured value of the company. Miscellaneous expenses. Miscellaneous income, such as with royalties. All paperwork regarding money owed to the company and money the company owes. New product development, if applicable. Current expansion plans in progress. The company's lawyer and accountant. Any litigation against the company in the past 3 years. Audited financial statements. Forms of incorporation and corporate papers if the company is a corporation, including a good standing certificate from the state's incorporating body. Sales, marketing, and advertising info. Price lists, catalogs, etc. Customer research, information. Competition research, intelligence. Comparison of competition with the business in question. Info on the technical operations and personnel. Patents, copyrights, and trademarks the company has. Physical description of the factory and office facilities, machinery, and equipment complete with diagrams. Description of the manufacturing processes. Any recent appraisal report by an independent appraiser. History of the business. Copies of any current business plans. A current credit report on the company. Are there any government regulations or environmental rules that could adversely affect business? Exit strategy of the contract. Financial strength of the company. Past performance. Cash flow analysis. Audit report. Pricing strategies. Geographic expansion. The proposed financing. Additional information. Introducing yourself to prospective sellers. Buying a business, especially from someone who doesn't have their business for sale on the market, is not just business. It's finesse, diplomacy, people skills, seduction. Some people go to a regional business directory, get a list of all the companies in their field in one local area, then write them a crappy form letter stating, "I'm looking for a business to buy, do you want to sell yours?" I have always been a champion of the direct approach, but in this case you have to dress it up. Explain who you are, where you're coming from. Tell them that you have enough assets to swing it. Prove it somehow by including a bank statement, a description, a corporate profile, or a photo of your business. Don't be insulting like an elitist looking to take over a business, smacking your lips like a vulture. Emphasize the mutual benefits. Say that sometimes in the affairs of life, people want to get out of business for one reason or another. If you think that this is you at this point in time want, perhaps we could set up a meeting and talk about it. Be as specific as possible, stating what you're looking for and how much money you can put up, because if you don't, you'll get a lot of queries from businesses that aren't what you're looking for. Rather than use the term sell your business, you might try something like, perhaps you would be interested in exploring a possible relationship between your company and mine. Describe your company. Provide a financial statement. Tell them about your plans for expansion. Be polite, not condescending like the big timer gonna swallow up the small timer. Propose exchanging a confidentiality agreement along with financial and operational information on the companies. After that, if they want a meeting, proceed. Emphasize a relationship over a takeover. A confidentiality agreement is a short legal letter that you can make up on your own or get your lawyer to make up where you say that you will exchange information and agree not to disclose it to anyone else. You can find standard forms on the internet. Just do a search of confidentiality agreement form, legal form, business warranty info. As the buyer, you should request a warranty in the contract so you can later support a claim of misrepresentation, fraud, or deceit if need be. If the seller's company is being liquidated, try to get them to sign the warranty as individuals so they will be personally liable if something goes wrong. Some basic facets of a warranty are: the property and business title are free and clear of liens and encumbrances. The seller presents the financial statements fairly and accurately. Contract rights and leases represented are in good standing. There is no material litigation pending against the company. All licenses and permits required to conduct the business are in good standing. There are no hidden liabilities. All equipment is in good working order. The seller too can request a buyer's warranty where the buyer acknowledges that all his financial statements are true, and if the buyer backs out for any reason, like he defaults on payments, the seller gets everything back and the buyer can't use knowledge gained like trade secrets, confidential information, or patents for himself. Conditions are less salient than a warranty, but if reasonable, they allow for the termination of the contract if they are not satisfied by the time agreed upon. For example, if you walk through the plant and see a bunch of broken windows and the seller says, "Don't worry, I will have them all fixed by closing day," and he doesn't, that's grounds for you to walk away. Try to get it in writing, but even if it's verbal with witnesses, that's usually good enough. The most common conditions are that the warranty and representations are accurate at the time of closing, the seller has done everything he told you he would do, the seller has provided all the paperwork, and there is no adverse change in the performance of the company at closing. If the seller is not satisfied with the buyer's financing for the transaction, he can back out provided he has grounds for his doubts. Even after you sign the contract, you should have a warranty and conditions in place if you discover something significantly faulty with the business or you simply don't think it's such a good deal after all. If one of the conditions is in violation, you can walk away and clean your hands of it even if it is a kind of shaky violation. That's what conditions and warranties are there for. Business brokers / business intermediaries / mergers and acquisitions professionals. You hire a business broker because they know what's going on and can probably get you a better price for your business than you can get selling it on your own. A success fee of 10% is common for transactions up to $1 million or so. There could be an upfront fee ranging from $500 to $10,000. These fees may or may not be credited toward the commission. Some business brokers try to charge excessively high fees to small business owners looking to sell. Don't hire a business broker until you check him out for honesty. Look for someone who has been in the business for 3 years or more. Many states require business intermediaries to have real estate licenses. International Business Brokers Association. IBBA.org. Investment banks do valuations and other business financing services. Due diligence info. Due diligence is not necessarily doing an analysis to come to a number for the value of the business. That's business valuation. Due diligence is checking on the company's paperwork, physical holdings, and operations to see that everything they claim is true and above board, no deceit, fraud or criminal behavior. If you uncover anything, it renders the deal void. Think of due diligence as the effort to confirm all material facts in the sales contract. It's a two-way street. Sellers should also perform a due diligence analysis on the buyer in order to ensure that he or she can pay the money, is not dishonest, has not been convicted of criminal fraud, etc. Some buyers come in, agreeing to terms where they will pay monthly, quickly trash the company for what money they can make, then take off, Even if the buyer is not paying his monthly bill, it's usually a tough legal process for the seller to kick him out. There are companies who do due diligence investigations. Answers.com/topic/due-diligence. AstuteDiligence.com, Chiokago. BusinessRanks.com/due-diligence.htm. ccohs.ca/osanswers/legisl/diligence.html, Canada. Buying a corporation. If buying a corporation, an individual or entity such as another business or an investor usually buy stocks/shares, the legal device used to determine ownership of a corporation. The person or company that owns most of the shares in a corporation is called the majority shareholder and holds the power when it comes to voting at shareholder meetings, namely the power to appoint who sits on the board of directors and management team. When the buyer purchases most of the stock in a company, 51% plus, he or she becomes its new owner. At that point, this entity or individual is the responsible party for the corporation, assuming all its assets, liens and liabilities. A potential problem when buying a corporation is disclosure. The sellers might neglect to tell you about pending actions against the company that have not yet materialized. These could be tax liabilities, legal actions, or future litigation that has not materialized, yet is based on actions done by the previous owners. The new owners take on that liability. Once you purchase the company's stock, you purchase its assets and its liabilities. There are hostile takeovers where you try to get enough shares/stocks of a company to make you the largest shareholder, 51+%, and friendly purchases where you negotiate with the largest shareholder, to acquire their shares, usually the managing directors. Before you embark on a stock transfer agreement, you should check some things out, like the following points. The understanding is that you are taking over enough stock to take over leadership of the business, therefore specify that in the warranty, that the shares will represent at the time of closing a majority percentage ownership of the corporation with the exact percentage stated. Also request in the warranty that the shares are free of encumbrances or other liens and that there are no hidden rules, bylaws, or proxies that compromise the stock transfer or deny you your majority owner vote in all situations. Very rarely are the shares of a major corporation sold for a fixed price. Generally, the price is a formula which takes into account the net worth of the corporation at closing. Some assets have a definitive, stable value, but others, like cash on hand, accounts receivable, inventory and existing debts, fluctuate all the time, therefore will change many times by closing day, so you need to work out a price formula with the selling partners. Large corporations are oftentimes sold for the book value of the shares at time of closing or based on audited financial statements. As with buying any company, protect yourself by getting a warranty to protect yourself in case of misrepresentation or fraud. Check to see if the corporation owns what it claims to own worldwide without liens against it or lawsuits pending. The corporation is in good standing with the IRS and state tax authorities. No money is owed and no audits expected. There are no government actions against it as with the Environmental Protection Agency, Securities Exchange Commission, etc. All contracts the company has to supply product or service are in good standing and not in danger of being terminated due to poor customer service. The real estate is in good standing regardless of whether it's owned or leased. The corporation has adequate insurance. The financial statements are accurate and there have been no materially adverse changes since. Get your accountant and attorney to write up your own warranty particular to the deal. Simply ensure that the business is as good when you buy it as when you first negotiated the deal, because unscrupulous corporate managers could try to take the inventory and anything else they can. A covenant is a part of the sales contract where the buyer imposes certain conditions on the seller until closing takes place. The normal covenants are that the corporation will not essentially trash the corporations by taking on new loans or new mortgages, making a bunch of new purchases, selling a bunch of stuff, defaulting on bills, setting up a bunch of new contracts and collecting money without delivering the goods, selling shares, issuing new shares. Just like with other companies, Have your lawyer draft up the conditions by which you can walk away or leave the sellers personally liable as with cases of misrepresentation, deceit, and fraud. If there are any loans, contracts, or tax liabilities within the corporation that require the personal guarantees of the corporate officers, these should all be nullified on the closing date and the new owners put their personal guarantees on these notes and contracts. Chapter 2. Buying a business 2. Business valuation / appraising a business 1. Business valuation is figuring out the value of a business. You can do a quick analysis of the business's worth by looking at the balance sheets, which should reveal what the business owns and what it owes. The balance sheet should state what equipment and property the company owns and what its liabilities are. With roots in the accounting / financial consulting industry, business valuators and business appraisers, also called private equity analysts, analyze businesses to determine their value for a variety of purposes like buying and selling the business, mergers, divorce settlements, liquidation of partnership or LLC, etc. There are 4 major methods of valuation for the purpose of purchasing a business. 1. Establishing net worth, based on the balance sheet, is the simplest but the least reliable in reflecting the true value. 2. Determining the market value of asset by pricing the value of goods and equipment at current market prices. 3. Capitalization of earnings takes previous earnings and extrapolates it to future earnings. 4. Comparative analysis of the business to similar businesses in the area. None of these methods by themselves are very good at determining the value of a business. Valuation is more a global process. You or the professional valuator get as much information as you can and make a determination from there. The motivation for the sale is important. Just like with selling cars, some people sell for legitimate reasons while others are trying to unload a lemon to an unsuspecting doofus, which is why you should do some independent investigating before you buy, even if it means sitting around in your car watching how many customers go in and out. Some of the main things to look for are: overall profit margin, cost of goods versus selling price to get a rough idea of profit potential. What does the business own in equipment and property? What does the business owe to suppliers, in debts and in taxes? Does the business own any patents, trademarks or copyrights? Will the seller start another business to compete with the one just sold? If you get a clause in the contract saying he won't do this, it is sometimes called goodwill. Is the inventory claimed physically there? Stock sales for public companies. Is there a healthy volume of trades on the company shares? Valuation models try to average out a range of values for a business based on either or both geographic area and all the businesses in a particular field. Business valuators use the usual business information vendor databases, the free government ones and local resources to help them come to a logical analysis of what a business is worth. Business valuation / appraising a business 2. There are business appraisers, lawyers, insurance agents, and certified public accountants all offering advice on what a business might be worth. Among business appraisers, there are some with no formal schooling and some with formal credentials. Business brokers generally undervalue a business because they want to sell it quickly, and the way to do it is to offer it at a low price. Look for the motives behind any business valuations you get from anybody to see if they make money if you sell the business. If they do, their business valuation will be low because they want a quick sale. You don't have to listen to anybody. Set your own price, advertise, see what happens and adjust accordingly. The majority of business owners overvalue their businesses due to emotional attachments to it and no knowledge of how to value a business. Hiring a business appraiser might show that your business is worth a lot more than you think. Even if you come up with your own value, a professional appraiser might see something valuable and increase the value. The 3 valuation approaches are: discounted cash flow, considered the best; the guideline company methods valuation; the liquidation balance sheet method valuation. The discounted cash flow (DCF) method is the basic valuation method. 1. Forecast cash flow. 2. Discount to present value. 3. Adjust the value for the appropriate level of control and marketability. Look at the record of historical sales, then forecast future economic profit margins and net income. Almost everyone wants to show their business value to the IRS as being low to minimize taxes. Business valuation websites. bvfls.aicpa.org, Business Valuation Section, American Institute of CPAs. nacva.com, National Association of Certified Valuation Analysts. bvappraisers.org. abramsvaluation.com, get free valuation spreadsheets to value your business. bvappraisers.org/glossary, the International Glossary of Business Valuation Terms. valuationsinc.com/resources. abosf.com, American Business Appraisers of San Francisco. inc.com/resources/valuations. American Society of Appraisers. Number 125. 555 Herndon Parkway, Herndon, Virginia 20170. 800 Osu Valu. 800-537-2069. 703-478-2228. Appraisers.org. Appraisal Institute. 875 North Michigan Avenue. Number 2400. Chicago, Illinois 60611. 312-335-4100. Appraisalinstitute.org. Appraisal Institute of Canada. 111 Portage Avenue. Winnipeg, Manitoba, Canada R3GOS 8. aicanada.org. International Society of Appraisers. Riverview Plaza Office Park. Number 320. 16040 Crisson Road. Seattle, Washington 98188-2929. 206-241-0359. Fax, 206-241-0436. 4appraisers.com. The buy-sell process. First, consider some of the thoughts that go through the minds of the buyer and seller during the decision-making process. The seller. Before the transaction. Shall I sell my business? What is it worth? How can I find a buyer? During the transaction. How much shall I tell this guy about my business? Will he raise his offer? What terms shall I insist on? After the transaction. Should I really have sold? I wonder if I could have got more money. Wonder how the business is getting along. The buyer. During the transaction. Shall I buy this business? I wonder why he really wants to sell. How much can I afford to pay? Where can I get the rest? How far will he reduce his price? After the transaction. Now that I've bought it, which new idea shall I try first? Should I have known that would happen? It's going to work out just fine, isn't it? These are typical thought patterns that reflect the doubts and hesitancy involved in the decision-making. Buyers and sellers both seek answers to the same question: what is this business worth? Most people see the worth of a business as the total value of equipment and fixtures, inventory, buildings, and land. The sum of these values does not equal the value of the business. There's an X factor in the form of the spiritual value of the business. Is it an entrenched part of the community where people like to go, or does it simply sell functional product with no relationship with the customers? Some other factors are: motivation. A decision to attempt the sale or purchase of a business. Contact. A decision on how to find a buyer, or seller, for a business with specified characteristics. Information. A decision on what information must be gathered or given to buy or sell a business. You must always make a full analysis by checking the area and checking the sales figures through public records. Don't take the seller's word for it. Check on competition in the area and the future trend of the business. Some people even hire an information broker or a private detective to learn about the business. Sources. A decision on how, where, and at what cost the needed information can be obtained. Analysis. A decision on the meaning, importance, and reliability of the information gathered. Value. A decision on what the business is worth. Price. A decision on how much money to take or give for the business. Financing. A decision on how to pay or receive the purchase price. Contract. A decision on the form and content of the contractual relation. Implementation. A decision on how and when to effect transfer of ownership. A business must be managed. An operating skill does not always lead to managing ability. In fact, it often encourages a business owner to spend his time operating instead of managing. Planning for the future, organizing resources, staffing the business with competent people, directing the coordination of people and operations, controlling results, these are the functions of management. Consequently, an individual with a skill seeking to buy a business in which to apply the skill should check his motivation by asking questions such as the following. How important is management ability in this business? Occasionally, a business that is unique and very simple almost manages itself, but if the business is in a competitive field, management ability is probably the most important requirement for success. Do I have the ability to manage successfully? Effectiveness with people, customers and employees, eagerness to tackle difficult problems and make decisions, and intelligence about general business operations are key ingredients in management ability. Can I learn how to manage this business? Most people can learn to manage if they recognize the need. This requires room to make mistakes, however, and the self-discipline to undertake self-improvement programs. It might seem that the price to be paid or received for a business would simply be equal to the value. However, value refers to what a business is worth, price refers to the amount of money for which ownership is transferred. There is usually a difference between price and value because the buyer and seller differ as to how much the business is worth. The price will represent negotiation and compromise. Discussion between buyer and seller should focus on the future profit performance of the firm. Since expected profit is basic to determining value, it can be a valuable point for negotiation. The bottom line, what it's worth. The bottom line is determining what the business is worth. The value must be acceptable to both buyer and seller or further negotiation is fruitless. It must result from the logical and objective efforts of all the parties involved. There are two basic methods of determining the value of a business. The first is based on expectations of future profits and return on investment. This method is preferable by far. It forces the buyer and seller to give at least minimum attention to such factors as trends in sales and profits, capitalized value of the business and expectancy of return on investment. The second method is based on the appraised value of the assets at the time of negotiation. It assumes that these assets will continue to be used in the business. This method gives little consideration to the future of the business. It determines asset values only as they relate to the present. It is the more commonly used, not because it is more reliable but because it is easier. The projections needed to value the business on the basis of future profits are difficult to make. The typical assets of businesses are cash, marketable securities, accounts receivable and allowance for bad debts, notes receivable and notes receivable discounted, accounts receivable and notes receivable from officers, employees, and owners, inventories, prepaid and deferred items, property, plant, and equipment, intangibles. Some claims against assets are accounts payable to trade, notes payable, accrued taxes payable, federal and state income taxes payable, unearned revenues, long-term liabilities, contingent liabilities, unrecorded liabilities, owner's equity. Barring a long-winded discussion here, the only real value of any business is its potential as a future money maker, so the bottom line is that it's more than the value of the building and the equipment inside. It's an intangible quality of how much profit it can bring in. Despite all the analysis, there are no guarantees. Just do your research well before you plunge in. The buyer should ask the seller to prepare a pro forma or projected statement of income and profit or loss for at least the next 12 months. For this, the seller will prepare a sales estimate for this period along with a matching estimate of the cost of goods sold and operating expense. The projected statement will reflect the net profit the seller believes possible. The buyer should then make his own estimate of sales, cost of goods sold, operating expenses and net profit for the next year at least and as far into the future as possible. In preparing these statements, the buyer should start by analyzing the actual statements of profit and loss for at least 5 years back. He should be sure that the past and projected statements provided by the seller are correct and are consistent with the buyer's proposed future operation. He should also study general and local economic changes that will affect future business. This includes competition. From the buyer's point of view, what is a fair rate of return from an investment in a small business? The rate of return is usually related to the risk factor. The higher the risk, the higher the return should be. The buyer of a small business should try to determine the risk factor of the new business, though this is difficult at best and in many cases impossible. In attempting to assess the risk factor, the buyer should project the profits of the business as far into the future as possible. He should ask himself how high the risk should be normally and look for conditions that would be likely to affect the sales and profit-making capability of the business. In any event, he should consider carefully the minimum return on investment that he is willing to accept. This concept of risk is important in valuing the business by capitalization of future earnings. The price to be paid by the buyer should be based on the capitalized value of future earnings. Instead, however, in most small business buy-sell transactions, price is based on the purchase and sale of assets. Profits are made by utilizing assets, of course, but actually the assets purchased are only incidental to the future profits of the new business. Capitalized value is the capital value that would bring the stated earnings at a specified rate of interest. The rate used is usually the current rate of return for investments involving a similar amount of risk. The capitalized value is found by dividing the annual profit by the specified rate of return expressed as a decimal. Assume for the moment that the future profits of a business have been projected for the next 5 years and are estimated to average $20,000 a year. This is in addition to compensations for the services of the buyer and any members of his family. What should be the sales price for the buy-sell transaction? What rate should be used in capitalizing the earnings of a small business? Usually, 20 to 25% is considered adequate. This means that the buyer should pay between $80,000 and $100,000 for this business. If it earns the projected $20,000 a year, the buyer will recover his initial investment in 4 to 5 years. This time will be extended by federal and state income taxes to be paid on the income, but this would also be the case for most alternative investments except non-taxable municipal securities. In using a computation such as this, the importance of long-run profits should be kept in mind. Unless profits are possible over a long period of time, 10 to 15 years, investment in a small business may be a poor decision. The trend of profits is also important. If all other factors are the same, a company whose profits are declining is worth less than one whose profits are increasing. Valuing the business on the basis of asset appraisal. The majority of buy-sell transactions are based on a value established for the assets of the company. This approach is not recommended, but if it is to be used, the suggestions that follow should be considered. A most important point is to find out early in the transaction just what assets are to be transferred. Usually, the seller has some personal items that he does not wish to sell. Prepaid insurance, some supplies, and the like, in addition to cash, marketable securities, accounts receivable and notes receivable usually are not sold. If the buyer does purchase the receivables, the seller may guarantee their collection, but such a guarantee should be established. The assets most commonly purchased in a small business buy-sell transaction are merchandise inventory, sales and office supplies, fixtures and equipment, and goodwill. One of the assets that must be considered in a buy-sell transaction is goodwill. Goodwill, in a general sense, arises from all the special advantages connected with a going concern: its good name, capable staff and personnel, high financial standing, reputation for superior products and customer services, and favorable location. From the accounting point of view, Goodwill is the ability of a business to realize above normal profits as a result of these factors. By above normal profit is meant a higher rate of return on the investment than that ordinarily necessary to attract investors to that type of business. The value of goodwill can be computed in either of the following ways. 1. Capitalization of average net earnings. As explained above, the amount to be paid for a business may be determined by capitalizing expected future earnings at a rate that represents the required return on investment. The difference between this amount and the appraised value of the physical assets may be considered the price of goodwill. This method uses only earnings in computing the price to be paid for the business. For that part of the calculation, it ignores the appraised value of the assets. 2. Capitalization of average excess earnings. This method recognizes both earnings and asset contributions. It starts with the appraised value of the assets and computes what would be a fair return on that value. If the estimated future earnings are higher than this fair return, the difference between the two figures, the excess earnings, is capitalized at a higher rate and the amount thus obtained is considered the goodwill value. This figure is added to the appraised value of the assets to give a price for the business. Payment of excess earnings is often stated in terms of years of purchase instead of in terms of capitalization at a certain interest rate. Capitalization of average earnings at 20% is the same as payment for 5 years excess earnings. The determination of goodwill usually reflects the value of profits that will be realized by the buyer above the normal rate of return, that is, the excess profits, but most small businesses that are for sale do not have excess profits. They usually show nominal profits or none at all. Often the seller makes an offer that seems quite good, but the buyer must be able to eliminate the seller's emotions and reduce all facts to workable relationships. If there are excess profits, goodwill is usually valued by capitalizing them at a fixed percentage established by bargaining between the seller and the buyer. The capitalization percentage needs to be high because profits higher than a normal return are difficult to maintain. Excess profits of $4,000 capitalized at 10% will give a goodwill value of $40,000, $4,000 divided by 0.10. Capitalizing the same excess profits at 20% gives a goodwill value of $20,000, $4,000 divided by 0.20. Although goodwill valuation is the first asset valuation to be discussed here, it is normally the last to be computed. Since few small businesses being sold are producing excess profits, the problem of goodwill value is not a pressing one in most buy-sell transactions. Merchandise inventory. In a service business, placing a value on the inventories is a minor problem, but in distributive and manufacturing businesses, the inventory is likely to be the largest single asset. A manufacturer, for example, has 3 inventories: raw material, work in process, fixed goods. Each of them present different problems in valuation. The distributive company has only one inventory, called merchandise inventory. The financial statements presented by the seller will probably reflect an inventory value different from the one assigned in a buy-sell transaction. Inventories are usually carried on the books either at cost or at the lower of cost or market. Market is defined as the current replacement cost to the seller. In determining the value of inventories, the seller has to choose a method of arriving at cost. The most common costing methods are first in first out, FIFO, last in first out, LIFO, and average cost. These methods may give very different values, and the buyer and seller must arrive at some value agreeable to both. The most common methods used in valuing inventories for buying and selling small businesses are cost of last purchase and current market price. The quantity of the inventory is usually determined by a physical count. The physical inventory procedures should be decided before the count, and each inventory team should include one representative from the buyer and one from the seller. It is easy to omit items from the inventory count, and here the seller is usually in a more vulnerable position than the buyer. There is more danger of omitting item from the count than of double counting them. It may be that some items of inventory are not to be sold. If so, these items should be segregated before the count begins. Another problem is determining what quality of items are to be included in the inventory. The buyer needs to be cautious when examining the inventories, in most buy-sell situations, there is some inventory that is not saleable. This is one reason why the buyer should employ as his representatives on the inventory teams individuals who are acquainted with that type of inventory. If the buyer and the seller disagree on the value of certain items, the seller will remove these items from the list of inventory for sale. When the inventory is being priced, be very careful in matching price to quantity. Be sure that the units in which the quantity is recorded and the units priced are the same. The physical count should be recorded in duplicate so that buyer and seller can each make separate extensions after all prices have been listed. After independent extensions, the two inventories should be reconciled. Manufacturer's inventory. When a manufacturing company is being exchanged, the raw materials inventory is taken and priced like the merchandise inventory of a distributive business. The work in process and finished goods inventories may present a problem. Usually, there is no market price or cost of last purchase to relate to these inventories, consequently, the seller's cost is generally used for establishing prices. If the seller has unused plant capacity or if his plant is inefficient, his costs may be inflated. Such a situation requires the help of an accountant with a good knowledge of cost accounting. Store supplies and office supplies. These two items are usually quite small. They should present no problem, though some of them may have no value to the buyer if the name of the company is to be changed. After the usable supplies have been determined, a physical inventory should be taken and priced as in the case of the merchandise inventory. Property assets and accumulated depreciation. The property asset account normally reflects the cost of the assets reduced by a provision for depreciation. In many small business buy-sell transactions, no real property is exchanged because the plant site is leased. The problem of establishing a value on real estate is not as acute, anyway, since the market value for real property does not fluctuate as widely as the market value for personal property. It is customary to have an independent appraiser establish a value for real property. Appraisers' findings on real property are usually more acceptable to both parties than personal property appraisals. The real property may have multiple uses, whereas personal property consists of single-purpose assets. The book value of real property will be close to the appraisal value unless the property has been held for a long period of time or unusual circumstances have caused sudden and drastic changes of real property values. Personal property assets. The buyer may feel that he knows going values of the personal property and decide not to retain an independent appraiser. In addition, many individuals believe that cost or book value is a good place to begin negotiations for personal property. However, because of the many methods of computing depreciation and also because of conflicting ideas about capitalizing cost, the cost or book value may not reflect a value that is agreeable to both parties. It is difficult to assign a value to personal property equipment because these assets have little value if the company is liquidated, therefore, a going concern value should be determined. The price to be paid for this equipment should be somewhere within the range of the cost of new equipment or the cost of comparable used equipment. For this reason, an independent appraiser can be useful, particularly if he is acquainted with the type of equipment being sought or sold. The seller should realize that he may own assets that do not appear on the fixed asset schedule. Many companies have a policy of not capitalizing any assets below some arbitrary amount, $100 or $200. A complete physical inventory should be taken. If the assets are numerous and geographically dispersed, the seller may be asked to prepare a certified list of the assets giving description and location. The buyer can then test the list by verifying only selected assets at the time of the sale but with plans to verify all of them within a certain period of time. The value of personal property assets is usually decided after considerable bargaining. It is better to assign values to individual assets rather than to make a lump sum purchase of assets. In a lump sum purchase, there is more chance of overlooking some asset values. The buyer should try to determine the condition of the assets as well as repair and replacement requirements. If he doesn't establish the condition of the assets individually, repair and possible replacement costs may create an unexpectedly heavy drain on his working capital. Federal income tax consequences. Federal income tax consequences of the buy-sell transaction may be an important bargaining issue if the buyer and seller are aware of them. The seller should be concerned about the amount of tax he will have to pay on his gains from the sale. The buyer should be concerned about the tax basis he will acquire as a result of the transaction. These concerns almost inevitably lead the buyer and seller into conflict in valuing the business. The income tax laws are highly technical and the possible variations in a buy-sell situation are infinite. Because of this, a discussion specific enough to be really helpful is impossible here. Both buyer and seller should study the applicable sections of the IRS tax guide for small business, and if an important decision in the buy-sell agreement is to be based on federal income tax consequences, the advice of an income tax expert should be sought. The seller should keep in mind that he must report any income tax liability he incurs by selling a going business. Reinvesting the sales proceeds in another business will not enable him to avoid or postpone his income tax liability. Chapter 3. Buying a business. 3. Generational transfers and management buyouts/MBOs. A generational transfer or a management buyout is a situation where the owners of a company want to sell it to either their children/relatives or they want to sell it to a group of managers currently running the company. In both of these cases, chances are these people do not have the money to pay for the company, so the current owners help them out by providing some kind of private financing plan with them. This private financing plan can either take the form of something like a private mortgage, or the buyers could start a brand new company, a Class C corporation or limited liability corporation, issue some preferred stock to the sellers that has dividends, a share of profits paid to them, and are redeemable for cash at some point later on. This situation of issuing preferred stock is listed as an asset on a company's books, therefore not listed as debt, which is good if the company is looking for credit or investors, because companies with too much debt on their books are looked down on and usually will not get credit or investment dollars. As a new corporation, its articles of incorporation authorizes it to issue both types of stock, common and preferred. The buyers buy the common stock of this new corporation, which is equivalent to what they can afford to pay for the company they're acquiring. They use this money as the down payment to acquire the old company. The preferred stock given to the sellers becomes the balance of the purchase price. This is roughly the way it works. If the down payment is higher than what they have on hand, they will have to borrow it somehow, probably by using this company they're buying as collateral. The value of the preferred stock which the sellers own is set at one value as part of the sales contract and stays there, fixed. If the company increases in value due to the efforts of the new owners, it's solely their gain. The two parties can set any terms they want. If the sellers want voting rights with their preferred shares, they can demand them, but many don't bother. They simply turn over control of the company to the new owners, then wait to cash in their preferred stock at some point in the future as agreed upon in the sales contract. If the company earns a profit, they pay a dividend on the preferred shares to the sellers who are the former owners. Redemption features of the preferred stock is set by both parties in the sales contract. They can come to any terms they both agree on. Seller financing. Seller financing is a situation where the seller offers to finance the buyer such that the buyer doesn't have to go to a bank and deals directly with the business owner in making payments. Just like I talk about how risky these deals are when selling a house this way in my money/real estate book, I don't think this is a good way to sell a business unless you know the buyer and can trust him. You don't know what somebody can do once you give them a business without putting anything significant up of their own. They could trash it, steal the assets, or simply move in, start doing business, not pay you, and then you will have a hell of a time getting rid of them. If you plan to offer a seller-financed deal, get a lawyer to write you up a good contract with some kind of quick repossession clause such that if he defaults for more than 60 days, he's out immediately and you retake legal possession of the business. A seller-financed sales contract can be a promissory note, a land contract, or some hybrid of the two. The major reason that a business owner offers his own financing deal is that no bank will give anyone a business loan to buy the business due to any number of things that makes the business look bad, like it's trashy, has low sales, low cash equity, dying business, too much competition, etc. Secondly, if the business doesn't have much in the way of assets but does a hell of a lot of business, a bank can't offer a loan because the selling price is too high for the actual assets it has, so the owner offers his own financing. It comes down to whether a seller finds an acceptable buyer with the motivation to actually run the business as opposed to trash it who doesn't have the money. As I already said, get a contract that gives you, the seller, the right to evict the buyer if he defaults on 2 payments in a row. Banks don't usually foreclose until after 1 year of default. If the buyer doesn't stay current with property taxes, insurance policies, utility bills, or lets the business go to hell as defined by you, get a clause saying you can repossess the property. The buyer has to protect himself too. If the seller gets one of these running the business to hell clauses, he could get very petty and try to sue for repossession, which means it will go to court and waste time and money for both sides. If you're the seller, as long as he pays you regularly, stay out of his way. There are greedy sellers around looking for well-intentioned young guys who want to go into business knowing they can't get financing through the bank, so they finance the business at an inflated price. If you're interested in a seller-financed deal, you should do a background check on the individual selling the business and run the business name through public records to see if it has liens against or was sued for unpaid taxes, etc. Get its income tax returns for the past several years. Be aware that most owners will lie about how great the business is doing. Do your own investigation. Drive past and watch the business. Send a friend in to see how they treat him. Try their products. Get a good business attorney before buying or selling a business. Get a clause saying the contract can be paid off early without penalty. Before you buy a business, ask the following questions. Is the business too good to be true? Is there goodwill between the two of you? Why exactly does he want to sell? Get it in writing in case he's selling for a different reason and hiding the truth, then you can sue him. Take over a troubled company. Take over companies that are in financial difficulty, and if that company is near bankrupt, it is not unusual for an outsider to take over and return the company to a profitable state. You will find such businesses in the newspapers, from business brokers and property agents who specialize in business sales. Once you have located such a company, get all the information you possibly can on how much it owes, its asset value, and why it is having problems. Is it due to marketing? Could its products be produced cheaper, and when was the last time the company showed a profit? Once you have all this information, work out on paper how much it is worth. This worth is what the company would fetch if it were sold. Put another way, the value of assets minus its liabilities once the company worth has been established. Try an offer of between 25% to 50% of this amount. The idea here is not to offer cash, but promissory, with, say, an option to pay over a 10-year period. If the owner of the company refuses, try again, this time offer a 5-year paying off period for promissory and try offering a profit-sharing plan as well. You could offer the owners part ownership by issuing them with stock or shares. Remind the owners that due to the dangerous state of the company, you will have to withhold payment on promissory and dividends to shares for at least a year, in order to give you time to make the company either profitable again or else sell off the assets to raise cash. Use the advice of a solicitor and have him or her draw up terms, closing the deal as soon as possible. Project a professional image. Employ business and marketing professionals to help you. Those already in the company may resent an outsider making changes. Remind them that thus far their own contributions have directly or indirectly led to the company approaching bankruptcy. The same goes for owners and shareholders. Keep on the present track and go under or grasp the alternative you are offering. After takeover, arrange to meet creditors individually. The creditors are concerned that if the business goes under, they stand little chance of seeing the smallest percentage of the debt owed being returned to them. Offer to pay from 1/3 to 1/2 of what is owed with nothing for the first year and over installments of up to 10 years. You might think creditors would not put up with this type of offer, but the alternative is being paid perhaps nothing at all as unsecured creditors if the company goes bankrupt. Having come to an agreement with your creditors, have them sign a letter confirming this new contract. You have now reduced the company's debts by at least 50% or more, given the company a breathing space of at least a year regarding repayments, and it has cost you nothing except negotiating. Your next trick will be to look at assets owned which may not be crucial to the day-to-day running of the business. Sell anything which is not essential, machinery, copyrights, property, vehicles, etc. If the sale of assets has not produced enough cash, you could always form a partnership of professional business people who have available funds, but your business plan must show them exactly how you intend to return the company back into profitability. You may need to discontinue certain products and concentrate on what the company does best. If part of the operation has been running at a loss with no immediate hope of a turnaround, get rid of it. Unless you strip your costs to the bone, the business will likely fail. Take over a sick business on easy terms. If you have little or no experience in a business, you have two choices: work for a company to gain experience in the field you want to enter, or buy an existing business. To buy a business, you need money. To get started, look for a business that is in deep trouble, one that is almost bankrupt. Many such businesses may be acquired with little or no down payment. They may be manufacturing businesses, service businesses, real estate businesses, etc. Why would someone offer a business for zero cash down? 1. The owner of a failing business wants to get out from under his bills and headaches. 2. He believes the business is beyond saving. 3. Finding a buyer for a heavily indebted business is extremely difficult. 4. Owner is old and tired. There are always plenty of cash flow takeovers available, whatever the state of the economy. These business offers are often advertised, but you have to look for them. Search through business ads in newspaper classifieds and trade magazines. Check with local business brokers and with local real estate agents who also handle business sales. Once you find a suitable firm, learn all its details. For instance, find out how much the business owes and to whom, the value of the inventory and all machinery, and the value of the building and the property itself. Look for a company in which the inventory and assets are higher than the debts. Also consider the sales income and expenses required to operate the business profitably. Examine such things as gross sales, selling and labor costs, taxes owed, etc. This information may be gathered from the firm's account books, income tax returns, or from an accountant's certified statement. Explain your belief to the owner that you can turn the business around and make it profitable, but that it will take at least 2 years. Here is a typical offer to make the owner of such a business. 0 cash down. Pay all company debts, promissory notes. No payments for 2 years. Be sure your lawyer draws up a proper sales agreement before you buy. You should also make arrangements to pay the attorney's legal fees from the business funds, not out of your own pocket. If you find that the owner insists on a nominal down payment, you may use any of the capital raising methods described earlier to come up with cash. However, you must insist on paying the bulk of the price with promissory notes. You must also insist that payments do not begin for a year, preferably 2. You will need that much time to turn the business around and show a profit. Once you acquire the sick business, you must take certain steps to make it profitable. The first step is to deal with the creditors. Here's what you do. Set up an appointment with each creditor to discuss the firm's indebtedness. Explain to each that you have just taken over the business and that you would like to pay off all the debts as soon as possible. Tell them that the business has no cash at the moment, but that you hope to start showing a profit in 6 months to a year. Your strategy is to convince the creditors to accept a reduced settlement of the debt. First, try to get a reduction of 30 to 70% of the total debt. You may also insist that payments do not begin for at least 1 year. Your third request will be for long-term repayment, 10 years if possible. Once the creditors accept your offer, make it legal by having them sign agreements. With this maneuver alone, you will have reduced your debt from 30 to 70%, lowered payments by getting the payoff time extended, and received complete debt relief for the whole year. Taking care of the business debts helps substantially. The business is then in a far better position to recover from its ailments, but don't stop there. There are other things you can do to improve its financial standing, such as 1. Sell excess inventories, finished goods or raw materials. 2. Sell obsolete production machinery. 3. Sell more company stock. 4. Sell a separate division of your company. 5. Split your company into separate firms and sell stock for both. 6. Make any cost cuts you can, reduce payroll, find cheaper supply sources, eliminate waste, etc. 7. Eliminate products, services, or accounts that are only marginally profitable. 8. Study how to increase sales and locate new markets. There are many businesses saved by using these methods. All too frequently, owners are completely unaware of the true value of their businesses. In many cases, an owner has exhausted his operating capital and credit through mismanagement and he's just plain tired out. Your offer allows him to recoup some of his investment and it may be the only one he gets. Leveraged buyout info. A leveraged buyout, LBO, is simply a situation where a person with a good credit record finds a business he wants to buy, then goes to lenders like banks, finance companies, etc. and works out a deal where he gets a loan to buy the business using the business as collateral for the loan. A leveraged buyout is a transaction in which a company is purchased primarily by means of borrowed funds. The lenders generally lend 75% of the business cost and want the guy to put up 25% of his own money. If you've got savvy, you might be able to pull it off. The idea is that you, armed with a good credit record and good track record of success in business, find distressed business owners who, for one reason or another, don't want to stay in their business but don't want to give it away for a song either. You approach them and/or business loan companies, banks, credit unions, etc., and convince them that you will deliver to them a good price for their business in the future, but for now, they must accept you on faith, turn the business over to you such that you will turn it around, make a handsome profit for yourself and pay them what they want for their business down the line after you've started turning a profit. This reminds me of the nothing down real estate deal, which some people call a gimmick. It takes guts and savvy to approach business owners and ask them to sign a contract to give you ownership of the business, putting no money down out of your own pocket but based on your reputation, offering them reassurance that you will start paying monthly payments in 6 months or so with the balance due in a balloon payment in 5 years or so. Just like if you had bought that no money down real estate infomercial package as I have for research purposes only, the gist of it is creative financing, to approach the seller or business broker and convince him or her, one step at a time, that you will give him his money in due time provided he gives you the reins of the company now so that you can generate the money to pay him. You make up a unique contract based on your discussions of the financing and bingo bango you're in. Easier said than done though. When you find a business that the owner might want to sell on easy terms, don't just blindly buy it. Do your research. See if there is some inherent flaw that will doom it to failure. Is the business conveniently located? Can you make a profit with it? Determine the true value of the business. Disregard the asking price and make a reasonable offer. Rather than going to the banks first for a business loan, strive for a seller financing deal. When going for a bank loan or SBA loan, offer the business as collateral. Another way to get a business is to try to set up a deal with business owners that you become a partner, business partnership, and take over day-to-day operations while they back off and wait for you to generate profits. Businesses in debt are easy to buy. Look for good businesses in trouble that you can turn around. Sometimes they will sell for the amount of money owed. If you're in a business that gives big contracts to the major suppliers for whatever it is you're producing, you could go to these suppliers and tell them you will offer them a big contract if they lend you the down payment. The business buying sharks look for businesses to take over with a delay of 3 months to a year for the down payment. Then once they're in, they look for things to sell within the business to generate the down payment, things like increase production, generate new markets, sell off excessive inventory, sell off some equipment, offer franchises/dealerships, sell the company's mailing list, license the patent and trademark rights, sell off a building or two, create a spin-off company, offer a deal to customers, pay now for lifetime service or for a new widget at half the retail price in 12 months, sell off motor vehicles, ask your business customers to pay up. If you can't make a deal on buying the business, ask the guy to let you lease the business for 12 months and maybe you can save enough for his down payment by then. Look in the businesses for sale ads in the newspaper. If you see the same ad in there for several months with the price going down or ad wording that makes it obvious that the owner wants out fast, go for it, make your pitch. Go to the business credit reporting agencies like dnb.com, experian.com, equifax.com and ask about buying a list of companies with poor credit ratings. You could put an ad in the paper saying something like, "I buy businesses, any business. If the price is right. Jake, 666-6666. From the seller's point of view, the quickest way to sell a business is to raise your current asking price but offer a no down payment deal in exchange for the higher price. You must find the right buyer who is serious about making the business a success. Books about leveraged buyouts are at number 658.16 or HG4028 at the library. Commercial Law League. 222 West Adams St. Chicago, Illinois 60606. Membership Group. Many bankruptcy lawyers are members. You could contact them for leads on struggling businesses looking for a buyer. Galeo & Co. 850 Boylston St. Brookline, Massachusetts 02167. 617-277-4165. Business brokerage that deals in troubled companies. Chapter 4. Buying a business for. The following chapter is a summary of the Buying and Selling a Business Guide at sba.gov. Analyzing financial statements. When the financial statements have been made as accurate as possible, the buyer or his accountant should analyze the information they contain. Probably the first analysis to be made is to compare financial statements for the past 10 years or as close to that length of time as possible. Has the trend over the years been up or down, or has there been no significant change? All items on the statements should be studied. The changes from one year to another will be more helpful if they are stated in percentages. On each year's income statement, the net sales figure is taken as 100% and each other item is stated as a percent of net sales. On the balance sheet, total assets are taken as 100% and other items are stated as percents of total assets. Such statements are called common size statements. Certain ratios and other expressions showing relations between items on the financial statements are also helpful in interpreting the statements. Current ratio. This ratio compares current assets to current liabilities. The current ratio establishes an important relation between the business' current debt and its ability to pay the debt. The assumption is that a company should be comfortably able to pay current debts from current assets if necessary. In many businesses, however, especially service businesses, current assets are proportionately smaller because there is little inventory. In these businesses, the relation of current assets to current liabilities may be less important. Acid test or quick ratio. This ratio points out the relation between the current assets that can be most quickly converted into cash and current liabilities. It is similar to the current ratio except that it uses only assets that are just one step away from being cash. One step away from cash means that only one additional transaction is needed to convert the asset into cash. For example, accounts receivable only have to be collected and marketable securities sold. Merchandise inventories that are normally sold on credit, on the other hand, are 2 steps away from cash. The inventory will first be sold and accounts receivable created. Then the accounts receivable must be collected before cash is realized from the inventory. Days sales uncollected. Days sales uncollected shows how fast a business collects its accounts receivable. One way to find this figure is to divide the year-end accounts receivable by the total charge sales for the year and multiply the results by 365. For this computation to be valid, the accounts receivable must be fairly constant throughout the year. In most businesses, however, sales and therefore accounts receivable also tend to be higher at certain times of the year. It is better to use an average if possible. Turnover of merchandise inventory. The turnover of merchandise inventory is the number of times the average inventory is sold during an accounting period. To find it, divide the cost of goods sold during the period covered by an average merchandise inventory at cost. A high turnover is usually a mark of good merchandising, but if the business only computes its inventory once a year and that at the low point of the business's cycle, the turnover may appear better than it really is. Return on owner's investment. The ratio of net income to proprietorship measures the owner's success in making a profit on the money he has invested in the business. Usually, net income after taxes and owner's equity as of the beginning of the year are used. If the owner's equity fluctuated greatly during the period, an average owner's equity should be used. Return on total assets. This shows the return on the total investment of all who have a stake in the business, creditors as well as the owners. Owner's percent of equity. For this percent, the year-end owner's equity is divided by the total assets. The share of the assets of a business contributed by the owner is always of interest to anyone trying to analyze the business. Creditors like to see a high proportion of ownership equity. The greater the owner's equity in proportion to that of the creditors, the greater the losses that can be absorbed by the owner before the creditors begin to suffer a loss. Creditors' percent of equity. The ratio of creditors' claims to total assets is always 100% minus the owner's percent of equity. The value of these ratios and percentages lies mainly in their use as tools of comparison rather than in their absolute values. Thus, a consistent increase or decrease in the current ratios of a business over a 5-year period establishes a pattern that may be significant. Suppose the current ratios for the 5 years are 7:1, 5:1, 4:1, 3:1 and 2:1. Clearly, the ability of the business to meet its current debt is declining. Another important use of ratios is to compare the company's performance with that of similar businesses. For almost every size and type of business, there are published ratios of expenses to sales that are accepted throughout the industry. A comparison between the ratios of the business offered for sale and averages for the trade will bring out any discrepancies. Some of the discrepancies may be due simply to poor management, but each one should be investigated. Evaluation of past year's profits. In using a net profit figure for past years to project the future earning potential of the business, the buyer or seller should exclude the profit of any year that is unusually high or low because of exceptional circumstances. It may also be wise to use a weighted average for the past year's profits. In assessing the future of the business, the buyer must take into consideration any changes he plans to make in the basic financial structure of the business, such as putting in additional capital or not buying all the assets. However, he should not pay for future profits he is going to earn by reason of his own special skills or additional investment. In determining the future income he is purchasing, therefore, he must rely largely on past results of the business operation. Effect of changes in price levels. When the buyer is analyzing several years' financial statements, he must keep in mind the effect on the statements of changes in price levels, that is, in the purchasing power of money. He should consider the possibility of converting the amounts on the financial statements to a base year. Goodwill, when it exists, is a valuable asset. It may result from a good reputation, a convenient location, efficient and courteous treatment of customers or other causes. However, because it is intangible and difficult to measure, goodwill is sometimes recorded when it does not exist. From the accountant's standpoint, goodwill should be recorded only when it is purchased. It should not be recorded otherwise, they believe, because of the difficulty of placing a fair value on it. As a practical matter, above-average earnings are normally considered the best evidence of the existence of goodwill, and the value placed on the goodwill at the time of its sale is often determined by capitalizing these extra earnings. Take, for example, a business in a field in which the normal return on investment is 10%. Suppose the business has a capital investment of $200,000 and an annual return of about $24,000. The average return on $200,000 for this type of business would be $20,000 a year, therefore, the business has above-average earnings of $4,000 yearly. Capitalizing these above-average earnings at 10%, $4,000 div. by 0.10, gives $40,000 as the investment needed to earn the $4,000, therefore $40,000 may be taken as the value of the goodwill of this firm. Many people feel that unless a business has above-average earnings, it does not have goodwill. Thus, a business might appear to have an excellent location, enlightened customer policies and a superb product, yet this business will not have goodwill attaching to it unless its earnings exceed the normal earnings for that type of business. The measurement of goodwill has many pitfalls. To begin with, a decision must be made as to what normal earnings are. Industry averages will probably be available, but average earnings for the industry aren't necessarily normal earnings. And once this decision has been made, the percent at which the above normal earnings will be capitalized must be decided. In the example given, 10% was used. This means that the buyer should recover his investment in 10 years. If he wants to recover his investment more quickly, he will want to use a higher percent, which will give a lower capitalized value. If he is willing to wait longer, he will accept a lower percent, which will raise the capitalized value. In summary, 1. Get financial statements for the past 10 years or as long as the business has been in operation. 2. Make whatever revaluations of the financial statements are necessary to make the statements realistic. 3. Prepare ratios and percentages as needed. 4. Compare results of the company's operations from year to year in the past and with results in the industry at large. Questions to be considered by the buyer. 1. What will happen to the profit when I take over the business? 2. How good is the accounting system that has been used? 3. How good is the cost system? 4. How realistic are the budgets? 5. How much owner's personal expense has been charged to or absorbed by the business? 6. Is there an equipment record for insurance and to tell me what it costs to maintain various types of machinery? 7. Is the insurance adequate? 8. What have the financing arrangements been, particularly if sources other than a bank were used? 9. What is the rate of return on capital invested and what rate of return do I want for my capital investment? The buy-sell contract. The final objective of the negotiation process is a written agreement covering the details of the proposed buy-sell transaction. Some of the details: price, terms of payment, price allocation, form of the transaction, liabilities, warranties, are matters over which the interests and motivations of the buyer and seller may be in sharp conflict. The seller is interested in the best possible price, getting his money, favorable tax treatment of gains from the sale, severing liability ties, past and future, avoiding contract terms and conditions that he may not be able to carry out. In contrast, the buyer is interested in a good title at the lowest possible price, favorable payment terms, a favorable tax basis for resale and depreciation purposes, warranty protection against false statements of the seller, inaccurate financial data and undisclosed or potential liabilities, an indemnification agreement and security deposit. The agreement reached by the parties, if they succeed in reaching one, will be the result of bargaining. Depending on the relative bargaining position of the buyer and seller, the buy-sell contract may reflect either compromise or capitulation. The central bargaining issue in the buy-sell transaction is price. Price is what is actually paid for a business. Value, as distinguished from price, relates to what the business is worth. The decisions of the buyer and seller as to how much to pay or take for each dollar of potential profit are a basis for bargaining, but all other relevant factors affect the final price. It's all about horse trading and bargaining. A number of problems in the buy-sell transaction are brought into focus by the necessity of writing up a contract. At this point, agreement has usually been reached on the major issue, price. Presumably, the buyer and seller have considered tax consequences, assumption of liabilities and terms of payment in arriving at a price. More is involved in drafting an adequate buy-sell contract, however, than mechanically reducing these oral agreements to written form. To protect the interests of both parties, the contract must cover possible problems that are often far from the minds of the buyer and seller at the time. What if the buyer defaults on his installment payment of the purchase price? What if the seller's financial statements, which the buyer relied on, turn out to be inaccurate or false? What if the seller turns out to have liabilities that have not been taken into account in the price? What if some of the assets purchased turn out not to be owned by the seller or are subject to undisclosed liens? What if material changes in the business occur before the buy-sell transaction is closed? What if the seller opens a competing business of the same type in the immediate vicinity? These questions reflect the uncertainty of the buyer's position. The seller knows what he is selling and what he is getting, with a possible exception in the case of seller financing. The buyer is getting an unknown quantity. Whether or not the buyer gets the protection he should have as part of the contract is a matter of bargaining. The basic elements of a typical buy-sell contract are: 1. Sale of business. 2. Purchase price. 3. Method of payment. 4. Adjustments. 5. Buyer's assumption of contracts and liabilities. 6. Seller's warranties. 7. Seller's obligation pending closing. 8. Risk of loss. 9. Covenant not to compete. 10. Conditions precedent to closing. 11. Closing. 12. Indemnification by the seller. 13. Seller's security deposit. 14. Arbitration of disputes. Financing the business. When the price has been settled, the question of how to finance it remains. Financing a buy-sell transaction involves these 5 factors. 1. The amount of capital required. 2. The type of capital required. 3. The specific uses to which the capital will be put. 4. The length of time needed to pay back the capital source from the business operation. 5. The sources of available capital. Capital must be available not only to pay the purchase price but also for: 1. Funds to operate until the business is generating cash. 2. Funds to meet unexpected expenses, and 3. Funds as a reserve to allow for errors in expectations. A buyer must think beyond the purchase price to determine the amount of capital he needs. Unless he does, he will find his resources embarrassingly and probably disastrously wanting. Here are some questions that must be asked about his capital needs. Do I have enough capital to pay the purchase price? Do I have enough capital to support 1 to 3 months operations such as payroll and other cash expenses while the business reaches a self-supporting stage? Do I have some extra capital to cover needs I may have overlooked, perhaps 10 to 15% of the purchase price? There are 2 basic types of capital. 1. Equity capital, investment in the business by the owner or owners. 2. Debt capital, borrowed capital that must be repaid. Equity capital is often called risk capital. Those who furnish the equity capital are expected to take the primary risks of failure and to reap the benefits of success. The equity capital provides a margin of safety for a lender. The greater the amount of equity capital, other things being equal, the easier it is to get debt capital. The seller will be thinking about instruments of transfer that must be delivered at the closing, about compliance with the Bulk Sale Act, and possibly about making financial arrangements if the buyer can't raise the purchase price. The buyer's attention will be focused on financing arrangements, organizing his business to be, overseeing the seller's operation of the business in the meantime, and becoming familiar with the details of the business operation. Compliance with the Bulk Sale Act. Most states require the seller of a business to furnish a sworn list of his creditors to the buyer and the buyer to give notice to the creditors of the pending sale. The purpose of such a bulk sale act is to make certain that the seller doesn't sell out his stock in trade and fixtures, pocket the proceeds and disappear, leaving his creditors unpaid. Compliance with the statute gives creditors an opportunity to impound the proceeds of the sale if they think it necessary. Non-compliance or inadequate compliance may result in attachment of the property after the sale by creditors of the seller and voiding of the buy-sell transaction. The buyer should not close the transaction until he has made sure that all statutory requirements have been met. In general, the buyer has 2 options regarding the financing of the business. The first basic method of financing is person investment of the future owner or owners of the business. The buyer may pay cash for the business out of personal resources, establish a partnership, or sell stock. These forms of financing are commonly referred to as the use of equity or investment capital. The primary source of equity capital is the personal savings of the buyer of the business. Although many small businesses are incorporated, the sale of stock is seldom a source of capital for the small business. Few buyers have enough personal savings to finance the purchase of a small business without any debt financing. An individual may borrow money for the purchase of a business by obtaining a personal loan, by borrowing against insurance policies, or by refinancing the mortgage on his home. These debts are not direct debts of the business, but the debts of a small business, and the personal debts of the owner cannot be completely separated. Banks are the principal institutional source of debt capital for small businesses. The other basic form of financing is through borrowing or the establishment of credit. This method of financing may or may not require the payment of interest, but it does require the borrower to repay the principal, usually over a stipulated period of time or on a specific date. This method of financing is commonly referred to as the use of debt capital. Often the purchase is made through a combination of equity and debt capital. The seller as lender. A seller is sometimes a source of capital to the buyer of a small business. Before jumping at the chance, however, the buyer should ask himself these questions. Is there a good reason why commercial lenders would not approve my loan request? Is the seller so interested in getting out from under the business that he will take an unwise risk? Am I sure the business is as good as it looks? Can the business support the debt payments to which I am obligating myself? The seller, too, should pause long enough to answer some questions before he accepts an extended payment plan. How serious will it be if the buyer is unable to make his payments? What security do I have to protect my position? How capable of operating my business successfully is the buyer? Equity capital. In the simplest form of purchase, the buyer pays the full purchase price in cash. The buyer's investment in the business, at least initially, is full and complete. Whether the funds come from one person or more than one, the financial nature of the transaction does not change. The sources of equity capital are many and varied. Generally, they are in the form of bank savings. Or cash may be obtained from liquidating certain assets the buyer may own, such as surrendering life insurance policies for cash value or selling real estate, stocks, and bonds or other assets. Before disposing of assets, however, the buyer should ask himself this question: do I want to buy the business more than I want to keep these assets, considering both present and future values? For instance, if the buyer cashes $16,000 worth of government bonds, there may be a possibility of his making a higher profit, but the risk of losing his investment entirely will be greater. He should be as certain as possible that the expected return is worth the risk. An equally important question is how much the buyer should invest in the business. In general, the more he invests himself, the better chance he will have of borrowing at least part of the purchase price. A buyer may not have the capital, however, nor perhaps the inclination, to purchase the business outright with his own personal funds. How far he goes in this respect depends on his own cash resources, his confidence in the business, and his ability to borrow money or establish credit with others. Debt capital. In most cases, the buyer of a small business will have to borrow money or establish credit to purchase the business. Several factors will affect the use of debt capital for this purpose: the source of capital, the amount that can be borrowed, and the length of time for which the capital can be borrowed. Commercial lending institutions are the sources to which the buyer will probably turn first. The availability of financing through these sources depends on the security that can be pledged to the loan, the profit potential of the business, the prospect of repayment of principal and interest, and the general availability of credit. One of the major difficulties facing the buyer at this point concerns the collateral that can be pledged as security. The physical assets of the business, particularly fixtures, equipment, and land and buildings, will not be available for security unless they are free of other financial obligations. The buyer may be forced to look to his own personal assets such as cash value of life insurance, stocks and bonds, mortgages on real property, and so on. Less formal sources of debt capital may be open to the buyer, such as loans from friends, relatives, business associates, and the like. Many small businesses have been financed through such means. The seller as lender. A common source of debt capital is that supplied by the seller when he lets the buyer pay for the business over time. Why should the seller finance the buyer? probably because the desire to sell is strong enough so that the seller is willing to assume part of the risk. As in financing from other sources, the seller usually demands that the buyer pay interest on the amount being financed and repay the principal and interest at stipulated periods. The seller usually establishes his security on the more certain assets, such as fixtures and equipment. However, he may also assume the inventory as acceptable security without placing it in a bonded warehouse. The seller's philosophy toward financing the buyer seems to be that if the buyer should fail, the seller can take back the business. The major problem in this form of financing is that it is harder for the buyer to get additional financing from other sources when the seller has first claim on the assets of the business. As the first step toward financing the purchase of a business, the buyer has to find answers to two questions. How much do I need to borrow? How much can I afford to borrow? The answer to the first question depends partly on how much money the buyer has and how much he is willing to invest in the business himself. The less equity capital he has, the more debt capital he needs. How much he can afford to borrow depends on his ability to keep up principal and interest payments. If a buyer borrows from a number of sources, he may find himself committed to a repayment schedule that the profits from the business will not support. His borrowing plans should be related to the projected income statement prepared during his study of the business under consideration. In addition to funds for purchasing the business, the buyer must have enough working capital to cover the cost of operation until the business itself produces enough cash. In other words, the buyer must think in terms of cash requirements and cash flow for weeks and months ahead. A common mistake in buying a business is failure to provide adequate working capital. If sales and business costs after purchase of the business are expected to follow the pattern of the immediate past, the need for short-term working capital should not be hard to estimate. Chapter 5. Research on the business. Information research. The information needed to research a company can be grouped into three general types. 1. Market information. 2. Financial information. 3. Legal information. In the Buying and Selling a Business Guide at sba.gov, they dedicate a very lengthy chapter on how to research the company you want to buy. Some difficulty may arise in the information gathering stage because of poor records, unavailability of some information, lack of cooperation and the like. The seller has the advantage as far as internal data are concerned. He has free access to his own records, the buyer does not. If the buyer needs internal information to reach a decision, it should be made available to him. He should insist on seeing the company records and be wary of any seller who refuses to give him the information he needs or stalls in giving him records, which means he could be doctoring them. Market information. The biggest factors in market research are the location of the business, the disposable income of the citizens in the area, competition, and the general trend for that particular product line itself. The first and most logical step in buying or selling a business is to conduct a market analysis. A market analysis is a study of the present position of the business within its market area and of probable future patterns. It should include the growth pattern of the business being sold, the state of the market, the nature and extent of competition, all factors that will show the present market position of the business or that will affect its future. Consider these factors in your market analysis. Sales information. Sales history. Sales tax records. Bank records. Cost of goods sold. The difference between sales and the cost of the goods sold is called gross margin or gross profit. The higher the cost of goods sold in relation to sales, the lower the gross margin and the net profit. Many factors, both within the company and in the market of which the business is a part, affect the cost of goods sold. An investigation should be made to determine the following. 1. Average rate of stock turnover, particularly as compared to the normal or typical rate for similar businesses. 2. Extent to which invoices are being discounted. Paying invoices in time to earn the cash discount will increase both gross margin and net profit if the discount is recorded as a reduction in the cost of goods sold. A direct increase in net profit will result if the discount is shown as other income. 3. Freight costs to determine whether incoming transportation charges are in line. Among the records to be studied are vendor invoices, records of merchandise, payments to vendors, shipper receipts or bills of lading, and records of past physical inventories. Sales effort records. This information has to do with how much it costs in selling effort to produce a given volume of sales. It involves two types of costs. 1. Advertising costs, from invoices and statements for various forms of advertising and promotion. 2. Salaries and wages paid for selling, from payroll or social security records. If the business maintains salespeople in the field, as a manufacturer might, information on reimbursable travel expenses should be included. The purpose of gathering information on selling costs is to determine how well these costs are being utilized and to compare them with average figures for the kind of business being studied. Personal observation. Look out for the general appearance of the premises, both internal and external, particularly if direct customer contact is made at the place of business. Plant layout and apparent efficiency of operation should be carefully observed if the seller is a manufacturer or otherwise engaged in processing or assembly. Employee morale and general attitude toward the business should be noted, especially if current employees are to be retained. Employee records, including wage payment plans, employee evaluation and merit rating programs, training programs and so on, should be studied. Sources of market information outside the business fall into two general classes. 1. Competing businesses. 2. The total market of the business and the factors that enter into it. Analyzing market characteristics involves dealing with constantly changing forces. This is in contrast to the internal analysis, which concerns basically historical records. Competition. Unless the business has a monopoly of some sort, a study of the competition should be included in the market analysis. The competition may be local and well defined or quite generalized, depending on the nature of the business and of the market. Trade associations and other data gathering agencies, both governmental and non-governmental, are sometimes helpful in this area. A good deal of the information about competition, however, must come from direct investigation, business by business. Location. In certain businesses, location may not be too important, providing the physical plant is structurally sound and suitable for the business. In other cases, location may be a vital factor. An important point that should be looked into is the status of the location and any plans for proposed changes that may have an adverse effect on the future of the business. Urban renewal programs are causing many small businesses to look for new locations. So are changes in highways and streets, flood control programs, changes in zoning ordinances and the like. The buyer, whether he will own the physical plant or lease it, should look into the possibility of future expansion. Consulting a competent architect or engineer now may save trouble later on if the buyer should want to expand and leasing provisions allow him to. Population and purchasing power. The number of people within the market area and the amount of spendable income they have are important market factors. For many kinds of businesses, the total population is less important than certain segments of the population. A business selling hearing aids, for example, will be interested only in persons who have hearing difficulties. Many trade associations report the results of research on population trends and consumer expenditures. Other sources of data on income include the following. 1. Planning Commission offices. 2. Employment offices. 3. Research done by newspapers. 4. Building permits, especially in newly developed areas, and 5. Mortgage and loan companies. Numerous fact-gathering agencies develop and publish estimates of consumer income and expenditures for various classes of goods and services. General market conditions. A much broader yet vital part of the market analysis has to do with what might be called the general state of the market. Most of the discussion of market analysis so far has dealt with factors that have a direct influence on the business being bought or sold, company sales, location, competition, and so on, but these, in turn, are influenced by the overall economic conditions of the country and of the market area. These may be widespread movements such as national cycles of prosperity and depression, or they may be purely local conditions. Financial information. Both buyer and seller are interested in financial information affecting the buy-sell transaction. However, since the seller already has this information, it is a major requirement for the buyer to get and make use of as much of it as possible. The buyer can usually find financial information in the following places. 1. Financial statements. 2. Income tax returns. 3. Other internal records. 4. Other external sources. Balance sheet and income statement. The balance sheet is a statement of the financial position of the business at a given moment in time. The income statement is a summary of the revenue and expenses of the business during a specified period of time. These financial statements show only the past results of the company's transactions. The results of future operations may or may not be similar. Balance sheets and income statements in themselves contain important information, but they are most useful when a professional accountant makes a detailed analysis of them. A complete analysis includes a review of the manner in which the statements were prepared and perhaps also a review of the records and control features of the accounting system. This is especially important in a small business buy-sell transaction because the financial statements of smaller companies are not usually as professionally prepared as the statements for larger companies. An accountant should be brought into the buy-sell transaction as early as possible by the seller as well as by the buyer. Audited statements. In many buy-sell transactions, the statements are supplied by the seller, but the buyer reserves the right to conduct an audit of the seller's records. Or the buyer insists that the seller warrant his financial statements. Warranty of financial statements by the seller should be accepted with caution, however, because there does not seem to be any uniform definition of the term warranty. If the seller's financial statements are prepared by an independent accountant, the statements should show whether they were 1. Prepared after an audit of the seller's accounts, or 2. Prepared from the seller's records without verification by audit. If they were prepared without verification by audit, they may be quite similar or even identical to statements that would have been prepared by the seller's own bookkeeper. If they were prepared after an audit, they should include a statement of the accountant's opinion. Financial statements prepared without such an audit may or may not reflect the financial position or results of operation of the company. Most small companies do not have their records audited annually, but without an audit, it is impossible to tell how accurate the statements really are. Other considerations. The buyer should request balance sheets and income statements for at least 3 and preferably 10 years. If the seller is a new company, financial statements for the entire life of the company should be requested. Other financial statements are sometimes available to the buyer. These include such items as statements of cost of goods manufactured, if the seller is a manufacturer, application of funds and variances from the budget. Many small companies prepare financial statements only for income tax purposes and use those statements for all management decisions. This may or may not give the desired results. The parties to a buy-sell transaction are interested in statements reflecting the tax position, but they should concern themselves also with statements reflecting non-tax items. The buyer should request copies of tax returns for at least 3 and preferably 10 years, or, if the seller is a new company, for the life of the company. The tax returns are more important in buying the stock of a corporation than in buying the assets of a corporation, partnership, or sole proprietorship. The corporation is an income tax entity, the partnership and sole proprietorship are not. A partnership is required to file income tax information returns but does not pay income taxes as a company. The taxable income is passed on to the partners and they pay the tax as individuals. No tax return is filed for a sole proprietorship, but the income statement is included as a part of the sole proprietor's personal income tax return. The buyer should find out which tax returns have been examined by the Internal Revenue Service and which have not. This is particularly important if the buyer is purchasing the stock of a corporation. If a corporation with an operating loss is being acquired, the loss might have value and the buyer should satisfy himself as to whether this net operating loss can be utilized. In many instances, the only information available to the buyer is that found with the income tax returns. The financial statements are usually supported by detailed analyses of selected accounts. This might include some of the following items. Sales may have been analyzed by customer, product, division, salesman, time period, and any other classifications necessary. Purchases may be classified according to product, time period, territory, supplier, or other classification. If the seller is a manufacturer, he may have cost control reports that include analyses of material costs, labor costs, overhead cost, scrap sales, spoiled and defective goods and other items. There may be a cash flow statement, perhaps incorporated with the analysis of collections of accounts receivable and even a projection of cash requirements. Other external sources. The seller's suppliers are an excellent source of information for the buyer. They can provide records showing the volume of purchases by the seller. This information may be difficult to get in some cases, particularly if the seller informs his suppliers that it is proprietary information. Another source of data is the seller's banker. A banker can supply information about cash position, line of credit and other fiscal data. He may, however, be reluctant to release this information. The seller may have filed payroll tax reports, sales tax reports, excise tax reports, ICC reports, or any of many other government reports. Some of this information is available to a buyer. The buyer may seek information about the seller from credit agencies or credit associations related to trade associations. Usually, the buyer must have a contact with these agencies in order to get the information, but here are many ways to get reports about the seller. The seller, for his part, should be cautious about releasing information to the buyer. It is entirely possible that the supposed buyer is a competitor or may be one in the future. Often a seller is so anxious to sell that he supplies any information requested by the buyer without even getting a good faith deposit. He may spend many dollars in collecting the data for the buyer. A seller should not supply any information to anyone without first discussing the matter with his accountant and his attorney.